Good morning, folks. Welcome back. Today's discussion is going to be on gap theory and gap risk and what it means for your price study analysis. And the first in our examples is the Canadian dollar. And what I've shown here in this chart is the futures contract of March 2017 of Canadian dollar. Now I want you to take a look at this chart, what's shown so far, and I want you to take a look at where there may be a gap or two or a few. And if you're watching the recording, you want to pause the video here and take a look at the price action and study that and see if you see anything that I'm going to pull out. All right, you should have done the pausing exercise to see where this is leading you. All right, we're looking at gaps, and this is the Canadian dollar. And I want you to take a look at this gap right in here. This is the March 2017 delivery contract for Canadian dollar here, as you can see. And this down gap, okay, in other words, this candle here closes at 78.17. The next candle gaps all the way down here and opens down here at 77.60. So there's no trading in between these two price points, zero trading. Price trades softer, goes lower, takes out an old low, buys up all the sell stops, and the market rallies away. And then we have another gap in here where price is strongly wanting to go higher. What is it reaching for? To close in this gap. Price has only been delivered on the sell side, so price rallies up through it. Notice how the candles are green here. Perfect example of what I was referring to all the time with the efficiency model, where price has to give both sides of the marketplace an opportunity. Sell side, in other words, a down candle or bearish movement through that range, and then it has to balance out by offering it with the buy side or green candles. Red and then green, okay? All this gap gets closed in, and then it trades softer. Now I want to go back and show you. I don't know why this is, I'm getting all kinds of issues with connectivity today. No, I don't want to do that. If we look at the open, high, low, close bar, it's a little harder on your eyes, okay, but for me, the gaps stand out better when I use this instead of the candlesticks. So we see this gap here gets closed in. We create another small little gap in here. When price trades lower, it comes right back to that same area but doesn't close it in, goes all the way down, closes in this gap with this movement lower. Then it runs one more time up into this gap, closes it in perfectly, and then trades lower, seeking the sell side liquidity below old lows. The mentioning of bearish order blocks and bullish order blocks, folks sometimes quickly assume that they think they understand it. And probably some of you probably felt that way thus far in the mentorship, because we've done some overlap of what is in the free tutorials, but I've given you the opportunity to see what it looks like over live charting, be able to call things using the information, so that way it's not a static experience looking at an old video or a hindsight objective. Understanding what the market should do with these concepts before the fact, that's what you are paying for. So if we look at this movement here from this high down to this low, all of this in here is a gap. Just this is a gap over here. It's being done during trading hours. Price skips aggressively. It doesn't give you an opportunity to do a lot of buying and selling in here. It's only been sell side offered. Down close, down close. If you look at order block theory, this can't be a bearish order block, and this can't be a bearish order block because we're looking for up candles generally. That means you're going to be looking at this up close, not this one, because this one's inside the range of this one. And I'm going to transfer it back to candlesticks in a minute, but I want you to take a look at this for a moment. Since the highs were created on two down candles, okay, I've mentioned on baby pips, the first thing I talked about is swing highs and swing lows. And by referencing the open, high, low, and close of those three candles or bars that make the swing high, they're going to be very sensitive price points. And this is an example of what that means. If we look at a candlestick chart, okay, there is no bullish candle, which would be seen as the last up candle, where if it breaks away from that, that would be a bearish order block. If to use order block theory on a simple definition of up close or up candle and selling the bottom of that candle or the open, that's what folks think they understand. You know, there's been probably 5 or 6 people that have left, and some of them said, "You've already taught me enough. I know what I'm doing now." They have really cheated themselves because they don't know what they think they know. They don't have any understanding at all at the depth of what these concepts give you. They would look at this and say, okay, well, this is the bottom of the last up candle, so I'm going to sell short there. And then they're perplexed as to why it keeps driving higher. Why did it drive higher and then go lower? Because you want to look at the openings on these two candles that are driving up like that. We're going to go back to an open, high, lows, close chart, and I'll give you the details, and then we'll go right back to this chart again in contrast. So on this candle here, price has opened, traded higher, rejected, and closed lower. We opened on this candle or bar, we traded higher, rejected, and traded lower. These are not bearish order blocks because they're down candles. But I want you to focus on what the price has done inside these two candles. These are each daily candles or daily bars. The open here, price has been delivered on the buy side from that open all the way up to the high. The price on this candle or bar has been opened and delivered on the upside here. So from this open and this open, which one's the higher? It's the second one here. So price has been efficiently delivered on the buy side from this open here. Because from this open up to this candle or bar's high, go over to the previous candle or bar, that same range at that open here, it's also been offered on the upside. So price has tried to go higher here up to 0.77. And then on this bar, we've opened and traded almost up to 0.77 as well. But we've passed all the way through this area 2 times with an up movement. Then we move lower. So count that opening and any price action below it. The bearish order block begins at that opening, not this up candle here. Draw that out in time, and you can see that's exactly what happens here. Why is it happening there? Because the delivery of price has been offered on the buy side here twice. So from the range of 76.50 to 77, those 50 pips have been offered 2 times trying to rally up there. Price does not need to go back up there at all. It needs to only go back up to this open, because from that point everything else is down movement. Sell, sell, sell. So this creates a liquidity void or a gap during trading time because it's aggressively moving one side of the marketplace on the downside. So if it's only offering sell side delivery on price, to balance that out, every red candle here has to have a comparable up candle to balance that efficiency out. That opening becomes the bearish order block, and it hits it right here and goes just a little. Well, look at the opening on it. The open is 76.48.5. The high is 76. It only went 5 pips above it. Only went 5 pips above the opening price. But again, this is a futures contract. It's not Forex. But it gives us prognostication that, okay, well, that means, now what does that mean for Forex? If that's what we're seeing here, if this level here is a bearish order block for Canadian dollar futures contracts, what does that mean for US CAD at that moment here? I got to take a look at the questions now for this one. I only get some interaction. Gina says it right, bullish. Now remember, US CAD, what's the first currency in the pair's name? The dollar. So if we're bearish Canadian dollar and the first pair in the name of the Forex pair is dollar, that means if the futures contract on Canadian dollar is bearish, that means it's going to be bullish dollar. So US CAD is going to be bullish. Okay, we're going to take a look at Canadian dollar real quick and take a look at that. Give me 1 second. That day comes in at December 14th. Okay, so last Wednesday, December 14th. Let's take a look at Canadian dollar. Here's the 14th. Price trades down below the bodies, not into the wicks, because that's where the thinnest delivery of price is. We're looking primarily for the bodies of the candles. So if we know this, and we talked about this in live session, so that's why I said it's important to go back and watch all this stuff, because then you'll have the context of why I was saying what I was saying at the time. Price trades down into the movement below the bodies of the candles, but in this moment right here, that drive down, the only thing it's doing is closing the gap that's shown on that futures. So we have this opening right here. Now notice that price does not go all into these wicks. See that? Price has rallied from the open here, trades higher. It opens on this bar or day, opens and rallies higher. So what has this done from an algorithm perspective? What has this done for this area up here? It's offered what side of the marketplace? The buy side. So if we're rallying up, if this is ranged up 2 times in this area, and it's offered price on the, even if it's a down close, it's not important. The importance is the movement away from that level. We have delivered price 2 days on that up movement above 76.50 to 77, 2 times. So price has only been delivered on the sell side from that opening here, because it's the higher of the 2 openings. Is price expected to trade into the wicks here on the futures contract of Canadian dollar during all this movement? No. And the reason why we don't need it to is because price has already offered this range 2 times. So there's no reason for it to trade up there. Now, what does that same thing mean in relationship to the dollar CAD pair? If we go back to the dollar CAD pair, you're about to have an epiphany. These wicks are the same thing, just reversed on the currency contract of Canadian dollar, where we saw those 2 higher movements on Canadian dollar futures. All this is the reverse of it. So it's not necessary for it to trade down in there, because price has done what? It's traded the sell side here, the sell side here. So it only needs to go down below the bodies, okay, to dip into and allow that gap to close. Only thing is done here is we reverse the role, because this pair is inverted from what we see in the contract delivery on Canadian dollar futures contract. So that movement below here only dips below the bodies of the candle, okay, and then it does what? Exactly the opposite that the Canadian futures contract is doing, which is trading aggressively lower. We're seeing that rally aggressively higher. But all through here, price has been offered bearishly. Okay, so price has been offered all down here, down. But we use the bodies of the candles also for our perspective on where stops are. Okay, so in other words, to run down below to get into a liquidity pool, it does not require us to move below the wicks or below this shaded red area. See, if I ask anybody that's left the mentorship or that's in the free tutorial stuff, I guarantee, as a matter of fact, as an exercise and validity, okay, I'm going to go on to the free tutorial on free Twitter later on tonight, and I'm going to ask folks, okay, I'm going to hide all this chart here, and hopefully most of them won't even realize what I'm actually asking them about it. But I'm going to ask them, where's the liquidity at below the marketplace, you know, at this moment there? They're going to say the sell stops are below here. They're going to say that invariably. But you just evolved today to understanding why we're only looking for the liquidity run below the bodies of the candles, because the wicks, that's already showing us delivery of price on a retail perspective. In other words, this expansion down here, that's only allowing runs on liquidity at that moment. So it's already been down there already. It doesn't need to do that anymore. The bodies of the candles is what the institutions are following now. So below the bodies, that's where the liquidity or sell stops are, not down in these wicks. You ever notice how many times that a market will go real close to what the wicks have done, but they don't go down there and they trade higher and aggressively move away? If you go back to the bodies of the candles and ignore these wicks, because it's already been down there already, it doesn't need to go down there, but it will want to go down below the bodies of the candles because it's going to give them a very deep discount entry point. And also, that's where the sell stop liquidity is going to rest. It trades down below the bodies of the candles here and then rallies away, which is the opposite, okay? It's the opposite of what we saw in the Canadian futures contract, because in Forex, the first name in this pair is the dollar. So if this is rallying, that means that the dollar's stronger. If this pair is going weaker, it's softer, that means the futures contract in Canadian dollars doing what? What direction is that going? If this pair, dollar CAD, is on our charts going lower, what's the contract doing in the futures market for Canadian dollar? Going higher. Right, Grace? It's going to be the opposite. Okay? Remember, the front name of your currency pairs, that's the underlying direction of that currency. So, like, for instance, dollar Swiss. Okay, if the contract on the futures market is going lower on Swiss franc, what is the dollar Swiss pair doing in Forex? Going higher, because it's going to be opposite. Think again, Rob. If the foreign exchange pair, dollar Swiss, okay, is going down, what's that going to mean for the futures contract price? What's it doing? Going higher. Okay, so you have to pay attention. Don't get mixed up over here with this stuff, because early on when Forex was offered as a asset class for me and I started delving into it, I made mistakes like that. I rushed in because I was looking at things from the futures market, and I went in and I did the wrong entry because I was expecting, like a few of you made a mistake and said it's this or it's that. No, it messed me up. And as soon as I realized what I did, I had to collapse the trade. And in a couple instances, it actually ran away, and I couldn't take any participation, and it's very frustrating. But I have had human moments like that, but you have to be very diligent about what you're looking at. And understanding it gives you a great deal of understanding about where the market's going to go. All right, so let's go back to barchart.com. All right, so we're seeing the importance of understanding what the open, high, low, and close does at swing highs. Because if you're looking at these as down candles, you'll never come away with that expectation of being bearishness up here as a selling point from the free tutorials. It's not there. But it was the first thing I hinted at in 2010 on Baby Pips, that you have to study at every swing high and low, the open, the high, the low, and the close, because it's going to give you data points to trade off of from an institutional perspective. It's exactly to that opening price, just by another 5 more pips, and then it aggressively sells off. Now you understand why it did this, and why I was telling you, look, folks, you want to hold for lower on dollar CAD, that's on you, but I'm telling you don't. And this is the reason why I said that. Okay, and it had very dynamic movement away from it. If we know, and if we go back into, let's say we're going to pick up another contract. Say you're pulling up Canadian dollar for the first time. This is the list you pull up. It gives you all these different contract months. Like right now, for whatever reason, it's still showing December. It's 26,506 on open interest, and then the next month out, which is March, it's 77,641. So more open interest is in the March contract than the December contract. And I mentioned earlier, but the recording, but I was mentioning how the contract delivery months for currencies and bonds and S&P are the same. It starts with the month of March, which is symbol H. Then it's June, which is, month code is M. September is U, and December is Z. Then it starts with H again at March, and that's the only 4 months that's delivered. Okay, but when we look at like gaps, like I was mentioning earlier, like right now, when the December falls off the board and March is 100% the only front month, the next month out will be June. You want to start looking at June when we have big reactions at swing highs and swing lows. It's clearly discerned on the March contract or whatever the nearby contract is. It's being actively traded, and that's actively traded by numbering how much open interest is in it. That's the contract month that you should be monitoring. Whenever that is determined, you use the next month out in your study because you'll see gaps in that next month out, and it'll look spotty. And when I first started looking at commodities, and we'll talk again more about this when we do commodities and futures trading, when I looked at nearby month and then the next month out, I was like, this is stupid because it doesn't give me any trading there. And I didn't realize the power of that because it's showing you a willingness to want to aggressively move one direction or the other. And when it creates that gap, it allows you to have a prognostication about what future price action may give us. Let's go over to the Japanese yen because I didn't get a chance to say this but in the recording. We have this down move here. Okay, price has been offered down, down, unchanged here. So price has only been offered sell side here. Then it gaps up to this price point here. So we have no trading in between these two candles or two bars. Big gap. Okay, price comes down, closes that in right here. It doesn't come all the way down to here. It doesn't need to. The sell side's been offered, so they're going to offer the sell side all the way through it to here. Once it closes in that range, then it's allowed to trade higher. What's it trading up into? This void. This quick down candle or down bar is essentially the same thing that you see with these gaps here, but it's just happening during market action, during the trading hours, where it aggressively skips down there. And then we can expect price to trade up, close in that range, and then it's allowed to trade lower. This little gap here from this opening, I'm sorry, for this close and this close open here, there's a small little gap in there. Trades up, closes that in. All this, what is that? August 26th. As a study for your own edification, go into August 26th, 2016. Don't do it now. Pay attention to what I'm talking about. There is a opportunity to see that range higher off the open. Look at the Asian market time and going into Frankfurt and London. See if that movement right there isn't the Judas swing that closes in that fair value gap right there, and then you get that big move down. It's going to be seen in the opposite because we're looking at the Japanese yen and it's going down. So dollar yen is going to be doing what? It's going to be opening, trading lower, and then rallying. It's going to be the opposite of what you see in the foreign exchange that you see in the futures contract because the dollar is the first currency in the pair between dollar yen. So just be mindful of that. We have a big move here, drops down aggressively. It trades all the way back up here on the election, closes in this gap, and punches right on up into this area here. What's it balancing out? We've had 1, 2, 3, 4, 5, 6 down candles all through that range where it left this high. Efficiency has been balanced out by price being delivered on the buy side here, all the way up to this point right there. Closed all that in, balanced it out, and then it's allowed to trade lower. Swiss franc here, we have another gap. Here, there's no trading in between that. This close and this open, there's no trading there. That's a gap. Price trades down and it eventually snaps higher. Look at this gap here. Does it close in here? No. But it runs higher. What's it aggressively reaching for? To close in this gap up here. Then it does what? It gaps lower. This close to this open creates a gap. What's it do? Closes in that fair value gap right to the close and then trades lower. Creates another intraday gap with this big range down. It goes up, closes that in. But look what it does when it drops down. It goes in here and closes this gap up to the close in that range to here. Every swing high and low, you want to be looking at the open, high, low, and close, not just the high to the open on down candles for bullish order blocks. The folks that have left this mentorship have done themselves the greatest disservice they have ever done to themselves in terms of what I teach, because they think they know everything about it, and it's not. It has not all been taught to you. Believe me, it's not been taught to you. I purposely left things out because it's just simply too good for population to run around and share it on their blogs or put on their YouTube channels, okay? And the things that you're learning in the mentorship, I'm asking you to be mindful of it because literally this is not the stuff that people see in all the books. Chris Laurie doesn't teach this stuff. Sam over there in Online Trading Academy doesn't teach this stuff. I can give you a whole list of people that aren't aware of these things. They don't know it. It's not out there. Believe me, it's not. But when you get into studying it and you see it, okay, it's not ambiguous. It's not, well, I understand it sometimes in hindsight. No, you can clearly see it. It's there. It's absolutely there. And it's not always selling at last up candles for a bearish order block. That high may be encompassed by all bearish candles. And what do you do in that situation? You go back to the first thing I taught you, veiled in 2010. Look at the swing highs and look at the opening prices, look at the closing prices, the highs and the lows, because it's going to tell you everything you need to know on how to trade it when it returns back to that price point. Today, what you've learned is there are gaps in price. These gaps will want to be closed in. When it does gap, it shows a willingness to want to go aggressively someplace other than where that price was when it gapped away. So it's wanting to go lower. The way you see the gaps is you can use the futures contract to see where the gaps are. And you're going to see it by using the nearby contract and then the next month out. When you see an intermediate term price leg higher, generally you're going to see a gap sometimes in the next month out on your futures contracts, because it's going to be a strong willingness to go higher. Because, and here's the benefit of having illiquid markets, because the next month out, because it's got very little open interest, there's not a lot of trading in it, it's going to amplify and exaggerate where the gaps are. And that same gap's going to exist on the nearby contract. And it's going to exist in the foreign exchange market. So the gaps that you think you can't see because you're watching Forex, now you have no excuse not to know where they are, because you can go in there and use the use the futures market to find out where the gaps are that the foreign exchange market is going to rebalance. See, you're looking at the spot cash market, okay, when we're looking at Forex. But the futures contract, that's traded. They're really being traded. You don't know from the cash standpoint where price has been traded on an interbank level. You can't. Show me how you're going to get that, because you're not seeing that with DOMs, okay? You're not seeing that with market profiling. You're not seeing it. You're never going to see that. You're never going to see that. But you can get an accurate depiction of where that real buying and selling is with the futures market, because these contracts are literally being traded. They're literally being traded at those prices. So if it creates a gap in the futures market, that same thing can be transposed over into the foreign exchange charts. Sometimes it may require you to be inverted. For instance, like with the Swiss franc, in foreign exchange, it's the dollar Swissy. So everything we see in the contract months for Swiss franc futures, you have to reverse it. So if it's a down move into a lower level gap on the futures market contract of Swiss franc, it's going to be an upper movement higher into a gap above current price action in the dollar Swiss. By understanding that element and blending the two, you'll know quickly where institutional order flow is going to be driving. It's going to be aggressively seeking the liquidity that's offered inside these gaps. There's no trading there. It was down, down, down. So now to balance that out, it has to be done with an up candle or movement through it on the upside. And you see that happen here. I'm not saying that the futures market is the catalyst for price, because cash is the king. Cash is king. And that's what we're trading. We're trading cash prices in Forex. But you can't see the literal trading on an interbank level because there's no reference. How do you see it? You can't. You cannot see it. You don't know where the trades are. And that's why volume is waste of time. You cannot use volume. The only volume you're going to see is what your data provider or your platform or your broker, you're looking at that volume. You're never getting an accurate depiction of volume with Forex. You're not. But you can get real volume of buying and selling in the futures market, because they are contracts that are literally being traded back and forth. Can you give an example of how to look for where price is reaching? I did that last week with the Australian dollar, Sammy, and it went right down into the gap, filled it in. Now, if you don't have gaps that are relatively discernible, okay, then you have to use your other concepts. You're not just trading. And here's the thing. Some of you will say, you know what, this is now my niche. I'm going to look for this. And you're not going to have a whole lot of trading. but you'll have an idea on how to determine daily bias. Because if the market starts trading lower and breaking support levels, and there's a gap down lower within several hundred pips, there's going to be a strong willingness to go down several hundred pips to fill in that gap. You cannot watch what has been shown today and not feel empowered by it, because it gives you an X-ray view of where the foreign exchange market's going and why it goes where it does and why the reactions occur. Like if you look at that Canadian dollar, the dollar CAD, and that reaction that took place. Yeah, sure, it was all interest rate based, okay? But take that out of the equation. It already was predisposed to go higher because it had already went down into an area what we saw explained with the old high in the Canadian futures. Would I use this as a confirmation or prognostication? You're doing it as in both. You're doing it for both. Like last week, I didn't think that the Australian dollar would give it all to you on Friday, dropping down. But there's, it did. It ended up going down into it. Why don't I trade futures in Forex? I don't care to. I like what I'm doing with the foreign exchange market. I don't want to do it. If foreign exchange starts getting screwy, and I said this before, if there's any issues with Forex, I have no concerns because I can go right back and start trading the futures market. And that's the benefit of learning everything you're learning in this mentorship, because you're not learning to be a Forex trader. You're learning to be a trader where you can step into any asset class. That's what you're learning. I'm not teaching you turtle soups, order blocks, foreign exchange market. I'm a trader. For you to go 12 months through this and only come out of this with just how to trade Forex is a waste of your time, a waste of your money, and I failed. When you're done, you're going to be able to go into every asset class, sit down and say, okay, there's an opportunity here, and this is how I would trade it, and this is how I'm going to put my money to work for it, and I'm going to capitalize on that. And it doesn't matter if it's an up market or a down market. It doesn't care. You don't care, if the economy is good or if it's bad. You don't care. You'll know what to do. Certain asset classes perform well while other asset classes don't do anything. You're going to learn all about that as well. When we do mega trades, that's what that capitalizes on. Where these big moves are going to occur. When commodities are quiet, there's opportunities elsewhere. And when it's time for the commodities to get explosive, other opportunities go quiet. All this shifting between volatility is cyclical as well. So it makes it very easy to be able to go in and see where these big moves come and when to anticipate them, where to expect them, and where they're going to go to. And you're going to learn that my objectives in the mega trades are many times blown out. They're just completely well beyond where I thought they're going to go. But if you just get a quarter of the move I anticipate by teaching what I'm going to show you, believe me, it's crazy. It's insane how much opportunities there. And you get about 2 to 3 a year mega trade setups, preferably about 2 a year. But on good years, you can get 3 of them. But they're just, you're not going to understand how to do those well without having a full, understanding of all the other asset classes together. All right, here's the March contract of Australian dollar. And let's scoot over here a little bit. All right, you see this gap down here? It's really obvious down here. But we're going to drop out to the December contract. So we have this gap here from this bar's closed to this bar's open. There's a big gap in there. It came down just a little bit here, but it did not fill it. Now we're trading softer and going lower. That's why I'm telling you that it's going to keep going lower for this pair. Now, with this currency, Australian dollar, in the foreign exchange market, how is that currency paired with a dollar? Is it the front end or the back end of the paired name? So that means everything you see in the futures contract is the same thing you'll see in the foreign exchange market. Let me make it candlestick so it can be a little bit easier in your eyes. Okay, so that gap down here, now you're looking at this little red piece of a candle. That's before this down lower green candle. That big gap in here, that's what Australian dollar is going to want to fill that in. So we got about 60 pips or so before we would close that in. Maybe probably as low as, what's the high on it? 73.17. No, Who's that? $71.88. $71.88. So we have about almost 200 pips to go on the downside still on Australian. Now, take that information. If you look at what we've said last week, the reason why I told you the Australian dollar was going to go lower is because we had that gap here, fair value gap between this candle's high, this candle's low. It only delivered price on the upside here. And I didn't think we were going to get it Friday, but it gave it all to you on Friday. Trades up at the opening here, back into a breaker. Now it's going even aggressively lower. This is not done. It's not done. It's going to go lower because the gap on that futures contract is already showing a willingness. It's a lot lower than where we're at now. And that's why I'm saying we're going to look for that low down here to be violated. Now, think. A lot of you sent me emails in the past when I was talking about turtle soups. How do you know it's not going to stop at an order block and give you a buy, or it's going to go down below the low and clear that out? Well, in this instance, we can see that this is a bullish order block here, yes? In classic terms, this is a bullish order block, correct? We have a nice movement away, down candle right before the up move. That would be a bullish order block. Is it really a bullish order block in this case? Because we've already identified the willingness to want to see the futures contract to trade lower into a lower gap below here. So would you trust this as a buy, given what I just showed you on the futures market? No. Now, this could be an objective to take some profits off on a short, but don't look at this and say, okay, this is going to be a bullish order block. When you see these things, you're going to be able to blend. That's what I'm saying. At the end of December, I'm going to have the PDF file notes given to you because there are certain points, if I talk about, they overlap. Order blocks, turtle soup, not turtle soup, I'm sorry. Order blocks, liquidity pools, liquidity voids, and fair value gaps, they all overlap. But it takes understanding of what I'm showing you here today to be able to ferret out what an order block is going to be good when it's not. See, the folks that make fun about this stuff, they have wasted their time trying to sell every up candle, and they tried to buy every down candle, and that's why they're on social media saying that it doesn't work. But we're in here every single day talking about where the market's going, and it does it. Because you're seeing me using it. Now, you don't see me go into the details of why I'm calling certain things. I'm only using the information as we go in the mentorship, using just that context. But now, since we've introduced this, we'll be able to use it going into our analysis and say, okay, this is why I'm saying the market should go to this direction and this level. It's not enough just to have a order block or a liquidity void or now a fair value gap. You have to understand why should they take price down. Looking at just the foreign exchange market, this is, well, it's going to be down here, this down candle here. This will be a nice bullish order block. So you can look at that as an objective as well. But we're calling this to go lower than this low because there's a big old gap on the futures market for the Australian dollar. And it's going to want to seek that. Now, for the futures market to fill that gap in, that means the price of the cash market has to go down, yes? So cash is king. So if we understand for the futures market to be permitted an opportunity to trade at that level, cash has to allow that to occur. That means cash is at a premium right now. It has to go lower. To facilitate that trade in the futures market, cash has to decline. So if cash is going to decline, that's your prognostication to expect a lower movement in the futures contract, which will allow also confirmation for your Aussie dollar in foreign exchange to print lower or move lower or go below this low that we're identifying here. So it's not just simply let me buy a down candle and I'm going to make money because it's going to go higher, and I don't want to just sell every up candle, because you got to look in there inside the context of those reactions. Again, we're looking for intermediate term reactions. By having these points understood, it'll give you a greater insight about what price is doing, what has it done, and what's it about to do. If you can answer those three questions, you'll have no problem going into the marketplace, finding opportunities, trusting a bias, sticking with it, not getting out after 25 pips of profit. You'll be able to hold on to it a little bit longer and know with a great deal of confidence why you're doing it. the first thing that, this is what happens when I taught the order block theory too. As soon as I taught a down candle rate for a big surge in price, if it comes back down to that, you want to buy it. Okay. The quickest the quickest thing that came by way of that was, okay, every time price goes down to that level, I'm going to be a buyer. No, not to be entering as a new long, and I'm not saying that's not happening here. We're looking for a price to reach into that gap and fill it in. It does not equate to a buy to go long. It just means if you are above it right now, there's a premium. There's opportunity for you to see a further slide in Aussie dollar. So we're using it as an objective. When you use gaps to be a buyer, okay, you should already be in a market that's predisposed to go higher. If it trades down into that gap and closes it in, then treat it like a bullish order block. Then it'll rally. Don't just take the gap as a, well, now I'm going to buy. No, in terms of where we're at now, it's an objective to reach for a target. We're not looking at the far out futures. We're only looking at the nearby and compare it to the next month out. The next month out is going to be very close to what you're seeing in the nearby contract for the futures market. You only need to look out to the next month out. If you go anything more than that, then you're really going to get spotty. Next month out would be the June contract, because we're trading in the March contract right now for the currencies in the futures market. Let me show you what I mean by that one more time. Like if you're looking at Australian dollar, you pull up the chart list. It'll give you a menu to choose from. Like right now, all the open interest is in the March contract, 2017. The next month out is always the month after the nearby. Nearby is where the most actively traded is. Okay, March is the contract. You can't trade December right now. You can only trade the March contract or the June or the September or the December contract. I keep records of all charts. All my journals all have charts in them. I have old logs of charts with notations and things. It's something you should be doing all the time. Why are there different contracts at each quarter? It's a contract delivery month. And we'll talk about all that when we do commodities. Well, you can see there's 29 traders in the December contract of 2017. And you got one trade that's been made in Australian dollar in March of 18. That's out of that. There's nobody trading out there. It's too far away. It's too illiquid. Only the big conglomerates and banks will trade in those farther out contracts. Which chart you asking for, Andreas? Right now you're gonna be tracking the price action in the March futures contract. If you get an impulse swing higher or lower, and you think this is like an intermediate term price leg higher or lower on the nearby contract, which is the March contract right now, it's the nearby or most actively traded. You want to compare that reaction in the next month out, which in this case, if this is March, symbol H, the next month delivery contract in the futures market is what? June, correct? So by comparing that month price action compared to what you see in the nearby March delivery month, you'll see gaps occur. And when that gap occurs, it tells you, okay, well, I may have missed this move here. Let me go and wait. And if there's a gap up here, I'll wait for that gap to fill, and then I can get in there and take a trade. Or if I find something that's bullish down here, okay, I'm not saying that there is because obviously it's broken down. I'm just giving you an example of what would have potentially been there. If there was a gap up here, we could expect the price to trade up to that point. That would be a trade, get to that point to this point, and then you can sell short, with the expectation that the stronger dollar would send Aussie dollar lower. At what point during the bear run that started on the 14th did you start to consider the magnetic effect of the gap below it, or had you already been considering it? Last week when I pulled Australian up because someone asked me to pull up Australian dollar, I didn't want to talk about it, but someone asked me what's my opinion on Aussie and what was my opinion on New Zealand. And when I pulled it up, I told you what I thought was going to happen based on what I saw on my other charts. Like I said, I'm looking at one screen here, just like you are when I'm looking at my laptop. But I have 6 monitors over here to my right that showing me everything. Like I got one monitor that's keeping tabs on the bond market as a profile. It gives me all the stuff I'm watching for interest rates. And I have one thing that I'm watching for leadership stocks. And I have one over there that has the news wires that put up stuff. And my other stuff are just tracking currencies that I'm really looking at against the dollar. So I'm not actively looking at everything unless I'm being prompted. And because last week I was asked to do a perspective or my opinion on what I thought the Australian dollar was doing, I wasn't actively looking at Australian dollar. But because I was asked, I went in. You can go into the recording and actually watch me. You'd be prompted to do it. I commented on the Australian dollar going into that gap relative to what we shown a minute ago with the foreign exchange chart. And I just gave you further reasons why I believe the Australian dollar is going to go lower based on using the futures contract, which is what I see in my other computers because I have all that information at a click of a button. I look at all time frames, RT, not just daily. Well, Gomez, to answer your question about, is there something in the charts that tells me to expect that gap to be filled? Well, are we not bullish on the dollar? I mean, we've been talking about bullishness on the dollar for like 18 months. So if we're bullish on the dollar, what's that going to mean for Australian dollar? It's going to go lower, right? So if that's going to bend the knee to the dollar strength, like other foreign currencies are doing, it's prudent for us to determine where should it go down to. Exactly. It's going to try to fill in those gaps. Or it's going to take out support levels because there's going to be sell stops below support levels. And it's also going to allow price to be offered at a deep discount price where premium sellers that are in these levels up here at 75 or so, okay, the shorts that are up there, they're going to want to buy at a really cheap price to get the difference in their shorts. And you want to be looking for, when the market's going lower, support levels be broken. Why? Because below support levels there's going to be sell stops. Those sell stops become orders to sell to market, which is what we need to have liquidity for to be a buyer back on shorts. They're going to sell us an exit that's profitable. If you're looking at the March contract for delivery in the futures market, you're going to constantly, while that is the active currency delivery month, March, until March starts to expire, you look at March and you compare it against June's contract and you look for gaps. When March rolls over into June, okay, or if we get to like the last week or so of March, the open interest will start building up more in the June contract. At that moment, you want to be blending March, June, and then refer to September too, because you may see gaps there as well. But there's a little bit of a gray area where you have to transition from one contract to the next. Usually it's like a week and a half, 2 weeks tops, where if the open interest is really moving from one delivery month, which is nearby, to the next month out. There are some contracts that don't trade aggressively at all, certain delivery months. Like if you look at gold, well, again, I'm going off the track here, and we could talk about a million different things. But there are certain delivery months of gold that aren't really active, and I don't even know why they even offer those delivery months because they're illiquid. But nonetheless, in these currencies, in the bond market, in S&P, it's March, June, September, December. It's only 4 contract delivery months. And you just got to be able to be mindful that the gaps will occur in the next month out because they're already built in with lack of liquidity. But if there's a big surge in price, that's going to amplify where the gaps occur. And it'll allow you to be able to see that and you just transpose those ideas in the nearby or into the futures, into the foreign exchange market like we've done today. Yep, every commodity is done the same way. So if you're looking at oil, same thing. Same thing with like right now, I think if we can get a consolidation on the dollar, if we consolidate and go into a little bit of a range in here, which is justifiable, there's no reason why not to expect it, I want to buy soybeans. I want to buy a lot of soybeans. And I'll tell you the reason why. Let me show you real quick, and then we're going to close this session. All right. Here's the nearby contract, January. Okay, here's soybeans right now. We've had a consolidation. We moved out, came back down to the equilibrium price point of this range right in here. We've moved out. We've come back down into the consolidation. If we have a consolidation in dollar, what do you see up here? What's this? Now, if that's a gap and price is going to want to efficiently fill that in, that is a nice distance away. That's over $5,000 per contract in profit. So if I buy 20 contracts of soybeans, this could potentially yield me $100,000 in profit. This is telling me where soybeans should go if we consolidate in dollar that will allow soybeans to rally. If we have an issue with soybeans crop, that will also drive that up there. So when we have the commodity teachings, okay, all these things work together. And if there's a premium, let's double check and see if there's any premium in soybeans. This is a different kind of premium. All right, so right now we have 10.22 last, the next month out is 10.33 as it should be. So there's no premium. It's just all just regular carrying charge market. No premium. Every new month out is a higher price than the nearbys. That's a normal carrying charge market. So if that reverses ever, that means there's a huge demand, and that's like a loaded gun. It's huge amount of money being made available. Now January, I was looking at that contract, and that's not the highest open interest. So March is got 310,000 contracts. So let's take a quick look at that. On March had already filled that gap in here. You're going to want to see prices go higher on soybeans because that January contract still has time to trade. It hasn't expired yet. So even though it has the least amount of open interest, there's still a long side bias to it because it did not close the gap like you did see it in the March contract. Let's see what the next month out from March is. May soybeans, 86,000. You're probably saying, what's soybeans? If you eat food, trust me, you're eating soybeans. It's in there somewhere. They put it in everything. All right, so again, that same little gap is closed in here, but nonetheless, it still looks like it wants to go higher. The application of it, while it may be a little fuzzy to you right now, trust me when I tell you, once you figure out what I'm describing to you here, and it doesn't take anything except for just studying it, looking at it, okay? It doesn't take months and months and months. It literally takes one weekend going through your charts and seeing what this does, and it gives you a huge advantage of knowing where price is going to want to go to, why it should go there, okay? And when you know that and you can see it on a higher time, why am I looking for gaps on the daily chart? Let me ask you that question in closing. Why am I looking for gaps only on the daily chart first? Because these time frames, the daily, who's going to be able to push the daily price ranges? Can we as small traders do that? No way. Absolutely not. Only those individuals that have huge amounts of money can push price on these higher time frames. So if we can see where they're going to want to close in a gap, that gives us a huge insight to where prices want them to go. And if it's on a daily chart, that gives you all kinds of time to set up signals and wait for setups to get you in sync with that underlying move on the daily chart. Some of you cannot trade intraday, and you're all chomping at the bit to get to January because that's where you're going to be able to trade. That's going to give you your trading model. I can't trade on the intraday charts, Michael. I appreciate it. I can see it. It makes sense, but I'm not able to do that. Give me something on the daily chart. Okay, that's what January is all about. But this is an insight that helps you, and you'll see more of it taught in January's content. It helps you build why these daily charts should go where they're going. And while you don't have to have a 20 pip stop, you can trade with several hundred pip stop on a daily chart and still get several hundred pips paid out to you. And you can still get the same type of payouts, 3-to-1, 5-to-1 setups, but it's going to take a whole lot more time for this to pan out. So the velocity for your money being put to work is very low on those time frames. Hopefully, you can make changes in your personal life that will allow you to go into an opportunity where you can trade a 4-hour chart or a 1-hour chart and eventually move into where you can intraday trade and you get more velocity for your money. You turn your money over faster. It's not over trading, but it's putting your money at work faster and getting it back and put it to work again to make more interest. But you certainly can do very well just trading the daily charts and not do a whole lot of trading per year. I don't have a premium chart. Premium account with bar chart. I'm doing everything with the same access that you would have here free. All right, folks, that's it for today. If I make it any longer, it's just going to be more work for me to edit and all that business. So I'm going to close this one here and just remind you that the gaps are gold mines. They're absolutely gold mines. They're there for a reason. They show willingness to show strength to move away from that level. But when it starts to retrace or go back down and it's heading into that same direction, the probabilities are huge that these gaps will be filled. And if you can determine that range from where current price is and where those gaps are, that sets a bias. And there's no reason why you shouldn't be taking some action in that move, because if it has a greater potential to move 100 pips or more, why aren't you in there trying to get a piece of that? So with that, I'm going to wish you a very pleasant afternoon, and I will give you the rest of this week. All will be pre-recorded sessions. Remember last week, that was the last live session for like monitoring for setups. This week, I wanted to give you something live because I didn't have a chance this weekend to set up anything pre-recorded. The rest of this week will all be pre-recorded teaching sessions, and it'll also give me more time to build your library for the 5 teachings that I owe you for Monday through Friday for next week, because I will not be in session with anyone. They'll be just pre-recorded sessions that I'll just give links to each day. So you'll have content every day next week, but it'll be in the capacity of pre-recorded teachings. So have a good day. Thank you very much. Until then, I wish you good luck and good trading.